Welcome to Iron Financial. This is the place where we forge stronger portfolios, and we do it by hammering through all the market noise to get to the hard, structural truth of a company. Today, we are cracking open a true Wall Street paradox, one that needs a full forensic analysis. SelectQuote, ticker SLQT. So get this. The company comes to the plate, reports what looks like an absolute grand slam of a quarter, but instead of taking a victory lap, the stock gets dragged out behind the woodshed and beaten.
And we're not talking about a little dip here. This was a catastrophic collapse. So the question on every single investor's mind is painfully simple. What on earth did the market see that the CEO, the analysts, and pretty much everyone else missed?
That's it exactly. And that is our mission today. We are going to put on the hard hats, we're going to inspect the foundation of this company beam by beam, and we are going to determine if this thing is fundamentally broken or if this is a massive opportunity that's being forged right now in the fires of market panic. Let's get right into it. Okay, so let's start with the official story. This comes straight from the top, from the CEO, Tim Danker. I want you to really read these words. Very pleased. Execution, trajectory of our profitability, and cash flow. This is the language of maximum confidence. You don't say things like this lightly on an earnings call. This is a captain standing on the bridge, telling his shareholders that the ship is sound, the engines are absolutely roaring, and they are on a direct course to creating value.
Right. He's essentially saying, hey, just look at the scoreboard, folks. He's pointing directly to the numbers and claiming that they are in the middle of building a powerful cash-generating machine. You hear a statement that bullish, you'd expect a buying frenzy to follow, right? But that is the complete opposite of what happened. And that massive, jarring disconnect is exactly why we're digging in today.
And here is the market's brutal, unfiltered, and immediate verdict. A plunge of nearly 29% in a single day. You know, this isn't just a slight disagreement between the CEO and the market. This is a full-blown public rejection of management's entire narrative.
A total bloodbath. It's stunning. The market looked at the exact same set of facts that the CEO was celebrating and came to the polar opposite conclusion. It decided that CEO's confidence statement was, well, completely hollow. This is where all my alarm bells start ringing off the hook. Did Wall Street find some kind of fatal crack in the foundation that management was trying to paper over? Or did the algorithms just panic and throw a perfectly good company out with the bathwater? This number right here, negative 28.6%, that is the puzzle we have to solve.
All right, here's our plan of attack for today. First, we are going to examine the beat in the bloodbath, looking at the stellar numbers they posted versus the disastrous market reaction. Second, we'll expose the cracks in the guidance. Because you know what? The market is always looking through the windshield, not the rearview mirror. Third, we're going to deconstruct the specific headwinds that management blamed for all the damage. Fourth, we'll get our tools out. We are going to inspect the core business to see if that foundation is actually made of solid steel. Fifth, we'll pressure test the balance sheet, which they claim is a fortress. And finally, after all of that, we will weigh all the evidence and deliver the Iron Financial verdict. Is this thing an incredible opportunity, or is it a cleverly disguised trap? Okay, Section 1. Let's kick things off by examining the official story, the numbers that, on paper, really should have sent this stock into orbit. This is the evidence the bulls would be screaming from the rooftops. We have to understand the good before we can properly analyze the bad, and the very, very ugly. Now, just take a look at the sheer strength of this earnings beat. On earnings per share, or EPS, they delivered 26 cents. The street, Wall Street, was breezed for 17. That is not just a beat, my friends. That is a complete blowout. We're talking over 50% above expectations on the bottom line. Then you look at the top line, revenue, $537 million, sailing comfortably past what everyone was forecasting.
So hold on a second. Let me get this straight. They made way more money than anybody expected on way more sales than anybody expected. You open up any investing textbook, and that's an A-plus quarter. End of story. So why wasn't there a parade down Wall Street? Why did an A-plus report card get you a 29% haircut? If the company's past performance was this solid, then the problem, it has to be buried somewhere in what they said about the future.
And that is the absolute crucial point. The stock market is a forward-looking machine. It's a discounting mechanism. It cares infinitely more about where a company is going than where it has been. A great quarter, that's a nice data point, sure, but a weak forecast for the future can vaporize all of that goodwill in literally a nanosecond. And buried deep inside SelectQuote's earnings release was the real story, the hidden narrative that the market seized on to justify that brutal, brutal sell-off. And this slide, right here, this is the smoking gun. On the left, you see the old guidance. On the right, the new. Now, revenue is trimmed a bit, which, it's not great, but it's not a disaster.
But it's the next line down that triggered the earthquake. Adjusted EBITDA. And for those who don't know, that's earnings before interest, taxes, depreciation, and amortization. It's a core measure of a company's raw operating profitability. It was absolutely slashed.
Slashed is an understatement. They took the midpoint of their guidance from about $135 million all the way down to $95 million. That is a $40 million hole that just appeared out of nowhere. A 30% reduction in their expected profitability for the year. That isn't a small course correction. That is a billboard-sized red flag flapping in the wind. It just screams that the company's core earnings power is deteriorating, and that is precisely the kind of thing that market punishes with extreme prejudice.
Exactly. And the critical question now is to understand why. A $40 million hole doesn't just appear in a forecast out of thin air. There has to be a reason. So in Section 3, we're going to deconstruct the specific headwinds that management blamed for this. We need to figure out if these are just temporary storms that are going to pass, or if there's signs of a permanent structural crack in the entire business model. This is where we separate a valid explanation from just a flimsy excuse.
So this really is the central question, isn't it? What on earth could happen to force a company to just wipe out a third of its profit forecast, especially right after posting such a monster quarter? It just doesn't add up. So where did this $40 million problem come from?
You know, to their credit, management didn't try to hide from it. They were actually very specific about the causes. Let's break them down right now.
Management laid out two distinct $20 million problems that add up to our $40 million hole. First, a major national insurance carrier, one of their key partners, decided to slam the brakes on its marketing spend. Now, this is important. This wasn't targeted specifically at SelectQuote. It was a broad pullback that affected all of its partners. Think about it from the carrier side of the table. Maybe they're hitting their capital reserve limits, or they see a big shift in market dynamics and want to slow down growth to protect their own margins. Whatever their reason, they turned off the marketing spigot. That's a $20 million hit. Second, a previously disclosed change in reimbursement rates from what's called a pharmacy benefit manager, or PBM, accounted for the other $20 million.
It is really critical to note that management was very clear that the PBM impact is a one-time issue. They said it will not recur. But that carrier pullback, that feels different. That sounds systemic.
And just for clarity, so everyone is on the same page, a pharmacy benefit manager, or PBM, is basically a powerful middleman in the incredibly complex healthcare world. They are the ones who negotiate drug prices and reimbursement rates for millions and millions of people. So when a PBM decides to change what they pay, it has a direct and immediate impact on the profitability of a company like SelectQuote.
So what you're really telling me is that their entire business model is highly dependent on the strategic decisions of a very small handful of massive partners. If one big carrier gets spooked by the economy, or one PBM decides to change a number in a spreadsheet, it can blow a $40 million hole in their forecast. You know, that sounds less like a fortress and a lot more like a house of cards.
And that is the billion-dollar question that the market is asking right now. Is this a house of cards, or is the foundation actually built of something much stronger? That leads us directly into Section 4. Now that we understand the external shocks that hit the company, we have to inspect the internal structure. We need to look past all the noise from the partners and analyze the company's core operational strength. Okay, so this chart breaks down the company's revenue streams, and it reveals its two main pillars. The largest, at $262 million, is their legacy senior segment. That's their core Medicare brokerage business. And right behind it, you've got the fast-growing healthcare services segment at $231 million. Life insurance is a much smaller piece of the pie. The health of the entire enterprise clearly depends on the strength of these two main segments. So let's inspect each one of them individually. Now, look at this number. Just let it sink in. 39%. That is the adjusted EBITDA margin for that senior segment we just talked about. This is an absolutely critical data point. Management themselves call this the steel frame of the business, and for very good reason. It is a cash cow. It is incredibly profitable and remarkably consistent, delivering these kinds of fat margins, over 30%, for 4 straight enrollment seasons. This tells us the core legacy business is a high-performance engine that just throws off an immense amount of cash. And if the senior segment is the steel frame, then you can think of healthcare services as the high-octane growth engine. This segment grew its revenue by 26% year over year. That's fantastic growth. This is where the company is placing its bets for future expansion. So what you have is a highly profitable, stable core business and the separate, rapidly growing new venture right alongside it.
Look, those are fantastic internal numbers. I love to see it. But does having a strong engine really matter if two of your tires just blew out? A 39% margin is incredible, but is it durable if your partners keep pulling the rug out from under you whenever they feel like it?
And that's a question of durability. It all depends on the strength of the chassis itself. To answer that, we have to move to Section 5 and analyze the company's financial foundation, the balance sheet. A company with a weak balance sheet gets completely demolished by a storm like this. But a company with a strong one, it can weather it and sometimes even emerge stronger on the other side. Management claims they've been busy building a financial fortress. Let's see if that claim actually holds up under pressure.
This timeline here shows that this wasn't accidental. This was planned. Management clearly saw the storm clouds gathering on the horizon. Over the past year and a half, they have made a series of deliberate, strategic moves to fortify their financial position. They executed a securitization back in late 2022, they brought in a major strategic investment in early 2023, and then, most recently, in January of 2024, they locked in a brand new $415 million credit facility. Each one of these steps was designed to add another layer of armor to the balance sheet. They were preparing for winter.
And this slide powerfully illustrates the result of all that heavy lifting they've been doing. Before all these moves, they had a huge wall of debt coming due in 2026 and 2027. That's a ticking clock that can force a company into making short-sighted, desperate decisions. But with this new credit facility, they have pushed that entire wall out to 2031. This is an absolute game changer for them.
Okay, you know what? I have to give them that. Pushing your debt maturity out by 5 to 7 years is a serious foundational move. That buys them an incredible amount of breathing room and pretty much removes any near-term bankruptcy risk from the entire equation. That is a very strong point in their favor.
Now, let's pivot to the cash flow story, because this is probably the most crucial piece of the entire puzzle. Despite that massive cut to their adjusted EBITDA guidance, the number the market panicked over, the company is still forecasting positive operating cash flow of $25 to $35 million. And get this, that's a year-over-year improvement of more than $40 million.
Wow. Okay, that is a powerful counter-narrative. So what you're saying is, while the paper profits, or EBITDA, are taking a temporary hit from these external issues, the business itself is actually set to generate significantly more real, cold, hard cash this year than it did last year. You know, cash is king, and a business that is generating more cash is getting fundamentally stronger, not weaker.
And that brings us to the final section. It is time to put it all together. We've seen the good, we've seen the bad, and we have definitely seen the ugly. We've examined the surface speed, the deep cracks in the guidance, the external headwinds, the strong core business, and the newly fortified balance sheet. So now we weigh all the evidence and we deliver the iron financial verdict. Is this 29% crash an opportunity to buy a solid company that just hit a speed bump? Or is it a trap, signaling that there's a lot more pain to come?
All right, let's debate it right here. The bear case is simple, and it's really powerful. They slashed their profit guidance by 30%. That is a hard fact. The business is clearly and painfully dependent on the whims of its partners, which introduces a huge amount of uncertainty into the model. And right now, the market sentiment around this stock is just toxic. Nobody wants to be the hero trying to catch this falling knife.
But the bull case, I'd argue, is built on a much stronger foundation. The core senior business is a cash-generating machine with nearly 40% margins. The healthcare segment is a proven high-growth engine, growing at over 25%. The balance sheet has been massively de-risked, with that debt now pushed all the way out to 2031. And most importantly, the company is generating significant and, this is key, growing positive operating cash flow. The bears are reacting to the scary headline, but the bulls are looking at the underlying structure.
So, here is the iron financial verdict, step by step. 1. The market's 29% crash was an emotional, headline-driven reaction to the guidance cut. It was severe and it was swift. 2. Our analysis shows that this cut was driven by two discrete, external, partner-driven events. It was not driven by an internal operational failure. 3. The core business itself, that 39% margin senior segment and the 26% growth healthcare segment, remains fundamentally strong and completely intact. 4. Management strategically fortified the balance sheet before the storm hit, which gives them the flexibility and the runway to navigate this turmoil. Therefore, our final conclusion is that the market overreacted. It punished the company as if the core itself was broken, when all the evidence we see suggests the damage was external and, in one of those cases, explicitly non-recurring. The stock price today reflects the crisis in the foundation, but our analysis points to a storm hitting the walls of a well-built fortress. This defines it not as a trap, but as a potential opportunity born from pure market panic.
And we are going to leave you with this one final thought. In a market that is driven by fear, absolutely everyone saw the $40 million guidance cut.
That was the number that drove the entire narrative. But the numbers they ignored were the 39% core margin, the 26% revenue growth, the debt pushed all the way out to 2031, and the $40 million improvement in operating cash flow. So the ultimate question for any investor is this: when the market panics, where do you look for the truth? In the numbers that create the fear, or in the numbers that reveal the underlying strength? That's a question every investor has to answer for themselves. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.